Welcome to Exponential Finance, where we connect AI, cryptocurrencies, and markets to help you understand what matters and how to act each week. Today, we present a very interesting analysis of Bitcoin.
Okay, so let's just dive right in. The question that's on everybody's mind. Bitcoin took this massive 22% nosedive. It really felt like the floor just dropped out from under us. And immediately, the question started flying around. Is this it? Is the bull run over?
And right away, all the usual suspects got rounded up. You have people saying, see, it's the 4-year cycle, right on schedule. Others are crying foul, blaming whale manipulation. Then there's the idea that all the money is just moving over to the super hot AI trade. And of course, the theory that the long-term holders are finally taking profits. But what if everyone is looking in the wrong place?
The real answer might be hiding in plain sight, and it's way outside of the crypto world. Because it turns out, this was never just about Bitcoin.
So here's our first really big clue. Bitcoin wasn't falling alone, not by a long shot. At the exact same time, gold took an 11% hit, and the NASDAQ dropped 6%. This wasn't a crypto problem. This was a market problem.
And that right there, that correlation, is the key. When you see assets that are supposed to be disconnected all fall off a cliff together, it's a huge sign that some powerful external force is at play. We have to stop looking at Bitcoin with a microscope and start looking at the entire global financial system.
And when we zoom out like that, that's where we find the real culprit. It's basically a plumbing issue deep in the guts of the financial world.
So, the whole thing comes down to something called the overnight funding markets. This is the back room where the big players, we're talking banks, hedge funds, you name it, go to borrow huge amounts of cash just to keep their operations running day to day. You can think of it as the circulatory system of the entire global economy.
Now, to see the stress in that system, we just need to look at two key interest rates. One is called SOFR. That's the rate for borrowing when you put up super safe collateral, like a treasury bond. The other one is EFFR, and that's the rate for unsecured loans between banks, which is obviously a bit riskier. Now, logically, the rate for the secured, safe loan should always be cheaper than the rate for the unsecured, risky one. I mean, that just makes sense. But when that relationship flips on its head and the safe rate suddenly becomes more expensive than the risky one, whoa, that is a massive flashing red light. It's the system screaming that there's a critical shortage of good collateral. And that kicks off a domino effect. When these big institutions can't get the cash they need from the funding markets, they have no choice. They are forced to sell their most liquid assets, the things they can get rid of quickly for cash. And what does that mean? They sell stocks, they sell gold, and yep, they sell Bitcoin.
And here it is, the smoking gun. The data shows this huge, undeniable spike in that funding stress metric, that flipped relationship, in the moments right before the market-wide crash. It wasn't a coincidence. It was the cause. The system seized up and the liquidations began.
Okay, so that explains the why. That's why the crash happened. But the really critical question now is, when does this pressure let up? What happens next?
Well, the good news is that the bigger picture suggests this liquidity squeeze is probably temporary. There are really 3 key things pointing toward a recovery. First, geopolitical tensions that tend to spook the markets are likely to cool down. Second, the Fed is under a ton of pressure to start cutting rates, which would pump more liquidity back into the system. And third, even within Bitcoin itself, the long-term holders who are selling, well, they can't sell forever, and there's a huge base of buyers just soaking up that supply.
This whole event is actually much more than just a story about a temporary crash. It feels like a landmark moment.
It really signals Bitcoin's graduation. It's not just some niche asset moving to the beat of its own drum anymore. It is breaking free from the self-fulfilling prophecies, these stories that we've all been telling ourselves for years.
This crash really highlights a huge shift. The old Bitcoin was all about its own internal narratives, right? The halvings, the 4-year cycles, retail FOMO. But the new Bitcoin we're seeing now is being driven by the same massive forces that move gold and the stock market, global liquidity, and big macro trends.
Which leaves us with a pretty provocative final thought. For years, we've all been told to watch the halving cycles to predict where Bitcoin is going. But what if that's the wrong chart now? What if the real cycle we need to be watching is just the rhythm of the global economy itself? To learn more and stay up to date with the latest in the world of Bitcoin, visit exponentialtom.com and subscribe to the channel.